Just when the market seemed to be getting up off the floor, a horseshoe gets slipped into a boxing glove and down it goes again. QBE shocked investors with a big profit downgrade and the shares were slashed by more than 12%, although everyone watched last year's catastrophes on ABC News, so I don't fully understand why it was such a surprise. Anyway, QBE was entirely responsible for a slight fall in the All Ordinaries Index today. Apart from that, the rises and falls were about evenly balanced. Insurance company Suncorp got hit by some stray bullets from the QBE firing squad. Telstra lost some of its recent gains while Leighton and BHP went up. There was very little action on global markets. Wall Street was flat, Europe and London down a bit. And commodities were generally bid up, except oil, which went down despite the rising tensions over Iran. Tonight's graph demonstrates just how much financial market conditions have changed. It shows the 10-year government bond yield and the earnings yield for shares, which is just the total profits as a percentage of total share prices. It basically tells you what investors expect from the two assets, one risky and one risk-free. During the 90s, they were so in love with shares that the earnings yield was allowed to fall below government bond yields. But now a huge gap has opened up the other way. Investors are out of love with shares and expect 6% more from them than government bonds. The Australian dollar continues to hover around 103 US cents and 81 euro cents. And finally, a chart of the annual change in credit card limits. The RBA released figures today showing it's at its lowest ever growth rate. And that's finance.